Hello traders, I'm Ben Lichtenstein. Welcome to the TD Ameritrade Network special year in review coverage of the trade war. It was a year full of headline news regarding the U.S. and China's negotiations, and the TD Ameritrade Network was there to cover it every step of the way. Take a listen.
Tariff delay, pop, whatever you want to call it, but it's kind of faded here. What's important to markets, and is this going to be the big lift to equity prices that so many are expecting to kind of carry us to new highs?
Yeah, well, that's a big question, Oliver. I think everyone's trying to figure out right now how much of this stock market move that we've seen since the beginning of the year has been priced in.
Do we view the tariffs as having any role in potential, monetary policy or an impulse therein?
That's an interesting question. Powell actually did cite the progress in trade talks in the press conference, not in the press release, but that was one thing that he had mentioned in terms of why the Fed could have, say, a more binary response. They're being patient, but don't think that they're not going to act if they do see inflation tick up.
The tweets and the headlines are coming in fast and furious, and it's hard to keep up with them today, and they're certainly moving markets. To us, the big challenge is that this is not a great time for a trade war to escalate. We have economic growth globally that's actually moderating quite a bit. It's almost falling off a cliff if you look at Europe. China's slowing. Apart from trade and tariffs, this broad slowdown that we've seen in China is really continuing to take place, and we think that that's going to put real pressure on risk assets.
The stock market's going to go up and down and teeter based on the news du jour of the day regarding trade and where we've gone. And where we'll go here in the next couple of months. Right now, I think the consumer is holding this economy up, and we need to get a trade deal so that business confidence returns and we can get spending again in corporate America.
Joining me now is Bluford Putnam, the chief economist at the CME Group. He's here to talk tariffs and our year in review. Blue, it's great to have you with us. Thanks for joining us. Normally when we talk tariffs, we think immediately about the indices and the impact that it had on individual companies with exposure to some of the tariffs, but it also was impactful in terms of some of the currencies. As far as the British pound, they dealt with tariff concerns, potential tariff concerns as far as Brexit, and there was certainly a lot of US-EU negotiations that went on throughout 2019 and impacting the euro currency as well.
That's right. Currencies are very much impacted by, every trade involves a currency, Yeah. So it's pretty natural. We had a lot of movement in the Chinese yuan this year. It started the year fairly strong, weakened over most of the year, but toward the end of the year, it's gotten a little stronger as maybe a possible deal shows up. It's a very good bellwether for the trade tensions. Tensions rise, the Chinese yuan gets weak, tensions ease, it gets a little stronger. And then, of course, Europe. Europe is a Brexit, European Union story. The pound has really just bounced around all year, Sometimes it gets a little weak because they get nervous about a hard Brexit. But then toward the end of the year, it's strengthened a little bit, even though we don't know what's going to happen. It'll, be in 2020 now.
Yeah. One thing that I'm thinking of is the fact that, towards the end of the year, the U.S.-European trade tensions seem to increase, if anything, more than decrease in terms of the situation with U.S.-China. But we place a 10% tariff on the EU aircraft parts and a 25% tariff on a range of other goods. The impact that this could have, Blue, in terms of an economy that's already struggling.
Yes, the European economy is definitely struggling. Germany's probably in a recession. We'll know when the data comes out, but it's struggling. And part of it is trade, but the trade stuff is just now happening with Europe, toward the end of the year. So a lot of what's going on in Europe is the monetary policy. They went to negative rates with the ECB. Negative rates are a tax.
Yeah, you've talked about the impact that has on an economy.
Some people thought that would be accommodated. Well, the ECB did, but it hadn't worked out that way. So so the euro has been a little bit of a weaker currency.
Yeah. Let's talk about how there wasn't just impact in terms of the currencies, because we saw a Fed that went from a very hawkish position to a very dovish position, and a lot of that seemed to be directly or coincidentally tied, timing-wise, right around to when we started to see the impact from tariffs impact global economic growth.
Yeah, if you go back to 2018, the fourth quarter of 2018 was pretty rough on U.S. equities and equities around the world, down almost 20%. And that's when the Fed changed its mind. You know, the Fed raised rates 4 times in 2018, cut them 3 times in 2019. So, you know, if you had just gone to sleep, nothing would have happened for 2 years. But, you know, I think it's a good thing that the Fed has gone back to a much more neutral policy, and I think it portends well for 2020.
Blue, in terms of talking about tariffs, one of the goals, one of the objectives was to level the playing field, for one, for U.S. companies in terms of competing with Chinese companies. Also, it was to somewhat incentivize U.S. companies to move back to the United States. Did we accomplish any of those goals?
Well, we haven't got a trade deal yet, and so you have to take the long view. I mean, we have to get a trade deal, see what it is, and then wait a couple of years to see if we accomplish those goals. So the jury's going to be out on that. But the short-term impact of going from temporary tariffs to what looks like pretty permanent tariffs, what companies have done is realize they have to diversify around the world. If you're a U.S. company, you can't depend on sourcing from China. If you're a Chinese company, you got to watch out being the U.S. If you're somewhere in between. So what's happened is that we haven't seen manufacturing jobs come to the U.S., and of course the U.S. farmer has paid a huge price for the trade war.
Big time. Blue, you mentioned in past conversations how you think that in order to sustain some of the upside momentum we've seen in the stocks throughout 2019 into 2020, we're going to need to see a rollback completely, all tariffs off the table.
Well, I don't know if that's required for an equity rally, but if we got that, there'd be certainly have a great equity rally. But, you know, rolling back all the tariffs would be a very big deal, and it would, you know, we'd have enthusiasm about profits. But we paid a lot of the price in 2019, so I don't want to be too pessimistic about 2020 because we've kind of paid for the trade war, and now we just see what happens in the next year.
Talk to us about 2020 in terms of optimism headed into the end of the year. Is the focus just right now at this point economic data to see in terms of how much some of the impact that we saw as far as trade tariffs and some of the other global economies has on U.S. economic conditions?
Right. Well, we know that in 2019 the world slowed down. And the U.S. is part of the world, but it hadn't slowed down as much as the rest of the world. And I think that's pretty much the angle for 2020. The U.S. economy is still pretty robust. It's only growing at 2%, but that's not bad for an economy that has almost no labor force growth. So, you know, my glass is half full, definitely half full.
All right, definitely appreciate you joining us here. A great discussion here, taking a look at tariffs, the impact they had on currencies, rates, and full circle in terms of what to expect 2020 with Bluford Putnam. Really appreciate it, Blue. He's the chief economist at the CME Group. It's time to take a quick break. When we come back, one of the biggest sectors impacted by the trade war was the semiconductors. We'll go in depth on the volatility of the chip stocks next as the TD Ameritrade Network's year in review of the trade war rolls on.
Feel that? That's the beat of global markets, the rhythm of the world. But to us, it's the pace of tomorrow. With ingenuity, technologies, and markets expertise, we create the possible. And when you do that, you don't chase the pace of tomorrow. You set it. NASDAQ. Rewrite tomorrow.
Turn on my TV and boom, it's got all my favorite shows. I wish my trading platform worked like that.
Have you tried Thinkorswim? This is totally customizable.
Now this is what I'm talking about.
Focus on what matters to you with Thinkorswim.
Welcome back to TD Ameritrade Network's year in review coverage of tariffs and the trade war. It's time to talk about the impact trade tensions had on semiconductors, and for that we welcome in Angelo Zeno, the senior equity analyst at CFRA Research. Angelo, thanks for joining us here to talk trade war. One thing that stood out to me this year was how semiconductors largely managed to shrug off tariff concerns. Were you surprised to see them as strong as they were this year?
To be honest with you, if you told me at the start of the year that we'd see this type of performance in semiconductors, I'd kind of laugh at you. So from that perspective, yeah, I'm definitely a little bit surprised by it. We did think that semiconductors were due for a rebound type year, but from that perspective, I think the magnitude that we've seen thus far and the volatility that we've seen definitely exceeded our expectations.
Yeah, when you consider for the most part the year really started out with some warnings from Apple, the ripple effect there was felt widespread. They took a hit somewhat in reaction to, but certainly recovered strongly into the second half of the year.
Yeah, absolutely. When we kind of look at, to your point, Apple pre-announcing after the first trading day of the year on January 2nd, you look at who the biggest customers are for the semiconductor industry, Apple right at the top of the list, along with Samsung and Huawei, two companies that clearly have been in the news a lot this year, both Apple and Huawei. Apple more so good news as they've kind of exceeded low expectations that were set early in the year. However, on the Huawei side of things, we've seen some significant trade uncertainty on their side of things. But for the most part, since I'd say late June of this year, most of the commentary have kind of been on the positive side of things.
Yeah, I was noticing that IHS Markit, the research firm, used the word debacle to describe the chip industry performance in the first half of 2019. Chip sales plunged something like 14% year over year for the first 6 months of the year. I've heard numbers headed into the end of the year down around 30%, but yet again, for the most part, we see chip makers, some of those individual names have managed to hold near highs for the year.
Yeah, absolutely. So when we kind of look at the semiconductor industry, this is the space where investors like to bottom fish, right? So, when we look at where the market peaked in 2018 for semiconductors, it was well before the actual stock market peaked, and that being in March of 2018. So we saw a steep correction, and then we've seen some false starts. Our view in 2019 is we're looking at a full year decline of about 10%, but there will be certain areas of the semiconductor industry where you're seeing 20 to 30% declines, with a rebound likely of about mid-single digits in 2020. So we think right now that's what investors are doing. They're looking to kind of bottom pick, the fundamentals here on the space. We think you've finally seen the bottom in the fundamentals, but whether or not that's sustainable remains to be seen in 2020.
Angelo, we briefly touched on Apple and the role that, the impact that had or the ripple effect that created or could have. Concerns associated with Huawei were also a major focal point this year. It did seem like, though, companies found workarounds or either applied for licenses or found ways to avoid some of the ripple effect from Huawei. But I noticed something like 260 requests into November for licenses. That was a major speaking point at that time. Can you talk to us a little bit about the impact that Huawei had and what you saw?
Yeah, absolutely. So when we think about Huawei, they are the biggest customer out in China. They are a top 3 customer, we think, for the overall semiconductor industry. Critical for many chip makers out there, specifically the communications providers that are more kind of reliant on themes like 5G. So think about names like Qorvo and Skyworks Semiconductor, where they have north of 10% of their sales going to Huawei, and that exposure significantly declined here as we kind of went into the second half of the year. That being said, to your point, we have seen some exceptions given to those customers, and our hope is we'll continue to see that flow through going into 2020. But at the very least, those are the companies we think that have the most favorable risk reward going 2020.
Angelo, the optimism we've seen in 2019, the expectations for more to come, it sounds like you feel like in terms of 2020, is it all because of China trade potential resolution in terms of some of the tariffs, some of the negotiations process? Because if you look at the numbers, a 12-month trailing basis, for the most part, for the semis, the numbers aren't that good.
Yeah, you're absolutely right. And when we start looking at things, clearly, yes, it does hinge on kind of a better outlook out in China.
Okay.
But I'd also say this, the bar is set very low going into 2020 in terms of the consensus estimates for many of these providers. I'll also say we see the emergence of many secular themes going into 2020. The big one really is going to be on the 5G side of things. Apple's finally going to launch their 5G phones, we think, in the fall of 2020. We expect to see other hardware providers also follow suit with more 5G devices. And as a result, the first half of 2020, we think, is going to be an extremely important inflection point as far as 5G is concerned, among other factors out there, whether we're talking about autonomous capabilities, the electrification of the car, a reemergence or reacceleration of growth on the data center side of things, which was relatively quiet here in 2019. So a lot to be excited about on the fundamental side of things for the semiconductor space in 2020.
Sure is. Sounds like that will continue to drive demand. Really appreciate you joining us. Angelo Zeno, the senior equity analyst at CFRA Research. Up next, we'll hear from our chart master as he breaks down the technicals on a couple of the chip stocks, and we'll get our final takeaways next on the TD Ameritrade Network's year in review coverage of the 2019 trade war.
I'm gonna make the change.
Did I just witness a call to the bullpen?
Nope. Just called the TD Ameritrade trade desk.
Oh, it's great.
They're my first call when I got check a trade.
Always a good move. That's why you're the manager. I'll just sit back and co-manage. So what do I do?
Hey, just kind of point around out there, touch your face,
Well.
Yeah, like you've done it before, though.
Oh.
Make the right call with the strategy gut check from TD Ameritrade's trade desk.
Why did I add futures to my trading strategy? 24/7 access to diverse global markets, like wheat. Can you say growth opportunity? We should probably harvest that.
Hey everybody, Ben Watson, the Chartmaster here. We're talking about an area of strength that's been persistent throughout the entire year, and that's the semiconductor space. One of the leaders in that space, AMD, has been in a strong uptrend for the majority of the year. A little bit of sideways move through the middle section, but once it started to beat earnings, we see a big run back up to some new highs up above the $40 mark. Consistent with that big move to the upside, we see a big build in long-term sentiment, and the intermediate-term sentiment starting to follow along, putting the stock back up into that overbought range. Levels of support exist just under that $40 mark, and if it breaks down through that level 35, which was the top edge of that channel, becomes the new support. If it starts to rally, breaking up above 42 becomes that resistance that could take this stock higher. Now, for a look at the entire sector, let's take a look at SOX is the symbol. This is the semiconductor index. We can see that that trend is pretty consistently up as well, building into a long ascending triangle with some resistance just above the 1600 mark. So it triple tests that resistance. We get a big breakout, and now kind of going sideways and maybe giving us a little bit of an expansion pattern, but sentiment still moving in a positive direction. Definitely the semiconductor space not weighing on the market as a whole. Back to you, Ben.
Special thanks to our chart master for breaking down the semis. Now, I want to wrap it up with our final trade war takeaways. And for that, let's bring in Michael McKerr, the senior strategist of institutional trading education at TD Ameritrade, and George Tillis. Both are contributors across the TD Ameritrade Network. George joins us from Salt Lake City, Utah. George, we're talking tariffs and the impact they've had on markets this year, and how the U.S., the impact, well, for the most part, was somewhat muted, at least in terms of the indices. Is the takeaway they just don't matter, or that as long as they're not impacting eco data, they're not mattering?
Well, it's a good question, Ben. I think overall in the realm of policy, we actually have some favorable monetary and fiscal policy, which has actually offset the tariff and trade war policy that the Trump administration actually took on over the last year. So we're getting some positive, if you will, dovishness when it comes to the Fed. We had our tax policy, which seems to have trickled its way through the overall economy, and then, of course, down to the bottom line of companies' earnings per shares and reflecting in the stock prices. I think right now the markets are agreeing so far when it comes down to the prospects that the tariff and the trade wars have not necessarily impacted EPS, nor perhaps will they in the future.
George, you make a great point there in many ways. I mean, the fiscal potentially was what fueled the fire, at least for the consumer, because when you look at some of the larger agencies, everything from, we're talking the IFO, the EIAs, the OECDs, the IMFs, I mean, for the most part, they were downgrading growth forecasts across the board, but yet the consumer continued to surprise us for the most part in terms of the strength.
Well, I think so. I think it comes down to credit at the end of the day. We know that credit is very relatively abundant right now, and consumers really reflect the abundance of that credit. I think rather than the tariff policies that the Trump administration took, which at the end of the day, any tariffs in the long run is bad because it's a net negative for every country that participates in some sort of barriers to trade. I think monetary policy, the shift in monetary policy, especially in late 2018 taken by the Federal Reserve, really, again, shifted the aspects of credit availability to the consumers, and the consumer, of course, reflects the majority of our economic growth. So overall, despite the tariffs and trades did impact, of course, business sentiment, I would say more so than was really reflected in the economic data. The data, I think, was expecting some other things going on, especially with the continuation of more tight monetary policy, which, again, the Fed really turned to 180 and took a dovish stance.
Yeah, they certainly did, and that helped the market as well. Michael, let's talk a little bit about how the strong U.S. dollar rallying on directly tied to tariffs and this protectionist policy that we took on here in the U.S. How did that impact U.S. revenues per share?
Yeah, when you look at the financial markets, primarily the equity markets, you wouldn't really think that we've had these tariffs stay on for a protracted length of time. But when you look at the U.S. dollar has had a really consistent rise throughout all of 2019, and this does have a very close correlation when we look at the trade-weighted U.S. dollar, looking at the value of all the goods and services that are actually traded in between countries rather than the standard dollar index. When you look at the trade-weighted U.S. dollar, that has a very strong correlation with the actual S&P 500 revenues per share, or that S&P 500 sales per share figure. So when the trade-weighted U.S. dollar is climbing on a year-over-year basis, that does have a negative effect on those S&P 500 revenues per share. So far, we haven't really seen the market or equity markets come off in response to that, but that's something to look for in 2020. If you do continue to see that persistent rise in the trade-weighted U.S. dollar, that likely is going to weigh on those S&P 500 revenues as well as the EPS moving forward.
Do you think it didn't weigh on the S&P revenues and some of the individual names, the stocks, prices of these stocks, because we saw rates coming off? I mean, they remain very low, historically low.
Lower rates certainly does have that boosting effect of U.S. equity prices, discounting some of those cash flows. But when you look at the year-over-year numbers, primarily in that Q3, we did see a stagnation, so to speak, where there was no growth. Estimates were for a drop of about 4% year-over-year on the EPS and right around flat on the actual revenues. And so it came in right around those lines. So I do think the trade-weighted U.S. dollars rise did have a negative effect on earnings and on revenues into this year.
George, in terms of talking about some of the callous nature that the markets had towards U.S. tariffs and some of the back and forth in terms of U.S.-China trade talks, I wonder if it came from some of that 2 steps forward, 1 step back kind of a rhetoric that we saw, where it was a very hard-nosed approach at first, but for the most part, the Trump administration dialed back some of those, kind of that hard-nosed approach and some of the tariffs that they initially implemented. That seemed to kind of reassure investors in the markets.
I think it did, and I think the other thing to add what Michael brought up, which is a fantastic analysis, I think the U.S. dollar really speaks to the fact that we had a policy divergence from a monetary standpoint in the United States. I mean, the Federal Reserve even though interest rates, albeit on an absolute basis, are still relatively low, they were certainly higher on a relative basis to countries like Europe and Japan.
Yeah.
So that created, of course, an imbalance where the U.S. dollar rose and some of the S&P earnings fell as a result. I think right now, with the shift happening again from a monetary policy standpoint, as rates are coming down, that's easing some of that U.S. dollar pressure, helping lift EPS for U.S.-based companies selling overseas. Not to mention the step back, as you mentioned just a moment ago, as well. I think it comes down to the rhetoric and the overall menacing way or approach, if you will, when it comes down to the stance on China, which at the end of the day, it really comes down to, I think, the intellectual property and the sensitive nature of technology and semiconductors in particular, which the Trump administration seemed to have focused on. Initially, it was commodities, steel, and so forth. It moved into technology, and I think that sets a bad precedent overall, since we know that semiconductors are used in everything we consume and utilize every single day.
Michael, as we phase this broader deal out, do you think that we're at some point going to be sitting here talking about how mission accomplished, so to say, or some sort of a broader-based deal? Because some of the bigger picture discussions that we're still kind of on the table here, those are highly contested and potentially could go on for years, it seems like.
Well, those structural issues are really what started this trade war in the beginning. You look back to March 22nd of 2018, when we first got the initial story saying the U.S. was going to explore imposing tariffs on $60 billion worth of Chinese goods related to the IP theft and some of the more structural issues. Here we are this much time later, and those are still the thorniest issues that are going on between the U.S. and China. So I really think that in order for us to consider having a full comprehensive deal, it needs to happen fairly quickly. When you look at the fact that we've got a 2020 election cycle coming up, there's likely going to be a narrowing window of opportunity to get that broader deal, because when you start to get into a lot of these debates, you're going to see different opponents saying, well, where are we on this issue? And there may be a return to hardlining. So if we don't see one within the first few months of the year, we may have to wait until the election's over. And I think the administration had kind of been setting this up by saying, we're going to get a phase one deal, and then we're going to stick to phase 2 and 3 for some of the more structural issues. I think that as long as this continues to go on in this protracted manner, the negative effects of these tariffs are very undisputed. So you look at the OECD, the IMF, they continue to cut global growth estimates to their lowest since the great financial crisis. The OECD now only predicts global growth to be 3% for the global economy, but for advanced countries, the IMF is saying it's only going to be 1.7% for the US. So at some point there might be this pivot that we do need this comprehensive deal to avoid growth in the US falling very negatively.
Yeah, the longer it's drawn out, potentially the more impactful it is. George, real quick, I'm curious your thoughts in terms of traders. What's the takeaway? I mean, what have we learned in 2019, and how can we apply that in 2020?
I think the takeaway really is that growth expectations are muted, and I don't necessarily think the United States is really designed right now, especially the other major OECD nations and the developed world, as Michael elaborated on, aren't really designed anymore for growth because they're very capital-rich nations. But it doesn't necessarily mean because the economy is relatively weak, let's say sub 2% in terms of growth rate, that profit growth rate can improve, because we have to remember that US-based companies are international companies as well from their sales standpoint. So we have to sort of divorce, I would say, the aspects of real economic growth aside from profits growth, because profit growth is really what the market wants to see, and that can continue despite the fact that the developing world, places like China, of course, and other areas of the world that generate more GDP than, let's say, the developed world, that's where the growth is, that's where the profit drivers are. But that can certainly, of course, trickle back down into profitability and the overall equity, the equity health, if you will, or the health in the equity space.
Well put, George. Really appreciate you joining us. Michael as well. You gentlemen, thanks for helping us break it down in terms of tariffs, a look back at the year and the impact that this had on markets. Traders, that's Michael McKerr and George Tillis. And that wraps up our year in review of the trade war. Be sure to tune in to all of our year in review coverage right here on the TD Ameritrade Network. And have a great day, everyone.
24/7 access to diverse global markets. Right here. That's why I added stock index futures to my trading strategy. Now when I see ups and downs coming, I'm ready. Well played.
What do you look for when you trade?
I want free access to research.
Yep, TD Ameritrade's got that.
Free access to every platform.
Yeah, that too.
I want to know what I'm paying up front.
Yes, absolutely.
Now offering 0 commissions on online trades.